if you cut entitlement or print, which leads to inflation, are you still essentially punishing the same group of people?
It sort of depends, right? Like what you were saying before of like, hey, the guy in Argentina, it's actually not so bad. Some people like if you own your house and you've got your fixed rate mortgage and like your wages are going crazy, like if you're a GM worker and you're getting a 25% wage increase and your mortgage is 3%, are you sad or are you happy?
Yeah.
Like, are you ahead or are you behind? You're ahead. Now, that presumes, of course, that they don't let, a giant depression happen and, your wages bankrupt the company and they lay you off. And I don't think that that's the case. I mean, these guys have been getting underpaid relative to inflation forever. Management's certainly been getting these types of wage increases. So like, why not pay the guys too? Why not pay the men and women that on the line? I think they should. So it's, and the other thing too is to the extent that, the United States needs some sort of economic incentive to bring the trades back, to reshore, and the only way that's going to happen is with a sustained price impulse for labor. I mean, where I live, a nice house is housing here is probably I don't know how to do it to square meters, but you can probably get a 3,000 square foot house here for about $400,000. Okay. A plumber here will make probably $350,000 easy.
What?
Easy. And this is a nice brand new house for $400,000. You can get a beautiful 2,500 square foot, 30-year-old house for probably $300,000, and plumbers will make $350,000.
Hold on.
People have no idea the shortage of the United States has just gone through 40 years of the trades suck. And so no one went in the trades. Everyone goes to college. And guess what? All the tradesmen are all 50, 55, 60, 65, 70 years old. And there's no one behind them who knows what the hell they're doing. There were advertisements near me recently that for snow plowing last winter, $175 an hour. $175 an hour to plow snow.
Danny, that's £275,000 a year for a plumber.
Wild. Correct.
I don't mean that derogatory towards plumbers. I think they're important, but it's just, I would have guessed in the UK, you're maybe 60, 70 grand, Danny, as a plumber?
Yeah, and I think that would be a well-paid plumber.
Yeah.
Yeah, and they're more expensive than that in the more expensive American cities. I hear it's closer to $400,000 or $500,000 in Washington, D.C. Why? Because why be a plumber when you can be a lobbyist and make $1 million a year, sucking on the teat of the Washington deficits. That's the Cantillon effect. No one needs plumbers. No one needs. Turns out they do. It's eventually you do, and so we need some sort of price impulse to kind of say like, hey, son, have you thought about like going into the trades? And the only way you don't do that with like 2 years at 10% inflation. Like you do that with like 1965 to 1982, where, the real value of a bond goes from 100 to 15 or 20 inflation adjusted over 10, 15 years. And that's like what needs to happen. So I think I don't want to minimize, yes, retirees and pensions will be hurt by this. But again, sort of like the whole thing of like, people on a fixed income, the American and the Western, but the American in particular, baby boomers and silent generation have 30 trillion in wealth and like half of it's in stocks. Like they're the wealthiest old people in the history of mankind. So like if you get high rates of inflation and they lose on their bonds, their stocks are still going to go up. Corporate profits are going to go up nominally a ton. They're going to be fine. So retirees, generally speaking, are going to be fine. There are the vulnerable people right now. They are still, the most vulnerable in society are being taken care of by the government already. That's a cost of living adjustment issue. That's something you can work out, whatever. And I don't want to minimize it, but I don't know that that's as big a deal as is often thrown up in terms of, okay, retirees are going to be fine in the West and certainly in America if they really inflate. The working class, like they're going to be okay. Like it's actually, if you really get inflation going, I think they'll actually be okay. If you can kind of keep it sustained for a while. So that's how I thought about it.
Well, who's going to suffer then? Who's this going to punish?
Bondholders.
Okay.
You hold bonds. So who holds the bonds? The 73% of the Treasury issuance last year. I saw this. It was Barry Riddles highlighted it using I think it was a Bank of America chart, but maybe it was a Goldman chart. But 73% of Treasury issuance last year, or the last 2 years, was bought by U.S. households. So now, we're buying our own stuff now. We're using our own. Never smoke your own product. We're smoking our own product. Households needs an asterisk though, right? So for example, right now, U.S. households, according to the Federal Reserve data or Treasury data, own, I think, 1.6 or 1.8 trillion in U.S. Treasuries. The asterisk is because for whatever reason, nonprofits, within that data are U.S. domiciled hedge funds. So when I see the U.S. household holdings of treasuries go from $1 trillion to $1.6 trillion or $1.8 trillion in like a year, I don't think all 600 or 800 billion are from U.S. households. I don't think that's like grandma and grandpa like going en masse. I think there's probably at least half that are hedge funds that have gone into it. So, but ultimately, your losers are people that own bonds. But that comes down to it, right? It's print the money or default. They're going to lose either way.
I guess money going into bonds over the last 12 months makes sense. It's the first time kind of in my adult life that there's been any real return on any real interest rate. But is the issue that when interest rates drop, they can't all get out?
Well, the issue is that they lose in inflation terms.
Because presumably if they take that to term, that they still kind of win. Unless, I guess, your point being if inflation's higher than the interest rate.
That's what I'm saying is when you look at post-World War II, bonds lost money on average against inflation from 1945 to 1981 at varying rates. There were a few relative moments in time where they did okay, maybe made a positive real return. The bigger issue is when you let debt and deficits get to where they are, the United States will mathematically go into a debt spiral and a positive real rate. In other words, they can't afford, the U.S. government cannot afford to pay positive real rates to its debt holders on a very sustained basis. For moments in time, yes. But ultimately, again, if you ran this playbook out, they would default on those bonds. They're not going to default on those bonds, but just say in terms of the positive real rate would hurt the economy, hurt tax receipts, send interest expense up, send tax receipts down, deficits up against a shrinking balance sheet because rates are going down or rates are going up. So economic activity is going down, balance sheet down, issuance up, rates up. It's a vicious, and ultimately they would go, we're haircutting this or we're haircutting entitlement, right? That's it. It is not sustainable for the United States to pay positive real rates. It's not sustainable.
So why would anyone buy bonds then?
Everyone wants to trade. Hey, there's going to be a recession at some point because real rates are positive and we've, the yield curve's been inverted and it's always worked. And there very well may be a recession. I thought there would have been one sooner already. I mean, we saw the decline in GDP in the second and third quarters last year of 2022. But no official recession. I've been wrong on that. Maybe one comes, as best I can tell, it is I want to own the long end ahead of a recession for a trade, because if there's a recession, the long end has always rallied massively, and with the long end where it is, if rates go back to 2, I'm going to make 40% on the 10-year. Maybe. The thing I think that the other side of that trade that I think is the minority, and it's actually the side, and I could see a slight bit. I'm not saying that you wouldn't get any bit. What I think the variant perception is U.S. deficits today are 8% of GDP. In the last 3 recessions, the United States deficit as a percent of GDP rose 6% in 01, 8% in 08, 12% in 20. So if we say we're at 8% today and we have a recession, you would expect to see the deficit go up 6 to 12 points. So up to 14 to 20% of GDP. Like, I hear and I understand the logic for buy the long end ahead of a recession because it's always worked. But it feels like not enough people are saying, wait a second. Why on God's green earth would I buy the long-term debt of a twin deficit country that was going to be running a 14 to 20% deficit, 14 to 20% of GDP deficit possibly in the next recession? Like you don't buy the long-term debt of a country running 14 to 20% of GDP deficits when they're a twin deficit nation and they're in a recession. You don't. That's like, I can't even think of what it's like stepping in front of a running truck. Like, you buy hard assets, they're going to inflate like you can't believe. And that's what I think, that context that, again, could bonds rally at the long end? A little bit, sure. But I just think the 40% rally isn't going to happen because the supply is going to rise. And going back to the initial point, as the dollar rises, as it tends to do in a recession, that's going to reduce foreign demand as well. In fact, it's going to force them to be selling at the same time. So like the effective amount of absorption, the deficit might be 14%, but you might have another 3-4% of selling from foreigners and from US banks and from US pension funds that are sort of upset. And you say, well, the Fed will just buy it. Like, okay, yeah, then why the hell am I buying the long end? Why am I not buying Bitcoin? Why am I not buying gold as my duration exposure? And that's my view. It's like I get, okay, I want to own some duration if there is a recession, but I don't want to own long-term treasuries. I want to own gold. I want to own Bitcoin. I want to own something that's really going to respond to what they're going to have to mathematically do, which is print to finance these deficits. It could easily be double digits in America and maybe even 15 to 20% of GDP deficits.